You know, I've been thinking a lot lately about something that keeps me up at night, and at my age, that's saying something. I'm 99 years old, and I've seen more market cycles than most people have had hot dinners. But here is what troubles me. I see retirees today making the exact same mistakes that destroyed families back in 1929. And let me tell you, that's not a figure of speech. I was there. I was 5 years old when the crash happened, and I remember it. My father, he was a lawyer in Omaha, a good one, but even he wasn't immune to what was happening around us. I remember walking downtown with him, seeing men in suits, standing in bread lines. These weren't lazy people. These weren't foolish people. They were successful professionals, doctors and lawyers and businessmen who had done what everyone told them was the smart thing to do. They had invested in the stock market. They had believed that prices would keep going up forever. And when the crash came, they lost everything. Now here's what nobody tells you about 1929. The crash itself wasn't what destroyed most people. You know what destroyed them. It was what they did before the crash. It was the leverage. It was the speculation. It was the absolute certainty that they couldn't lose. And I see that same certainty today. I see it in retirees who have their entire life savings in stocks because someone told them that's what you're supposed to do. I see it in people who are taking on debt to invest because interest rates have been low for so long, and I want to grab them by the shoulders and shake them. Let me tell you a story. Back in the 1970 seconds, I went through my own version of a crash. It wasn't 1929, but it felt like it at the time. Between 1973 and 1974, my investment partnership lost about 31% of its value. 31%. Can you imagine what that felt like? I had investors who trusted me, people who had given me their money because they believed I knew what I was doing. And I had to look them in the eye and tell them that nearly a third of their wealth had evaporated. But here's the thing. I didn't panic. I didn't sell everything and run for the hills. And do you know why? Because I understood something that most people never learn. I understood that the market is not the economy, and the economy is not your portfolio. These are three different things, and confusing them is what gets people into trouble. You see, when I was younger, I made a decision that shaped everything that came after. I decided that I would rather be approximately right than precisely wrong. And what does that mean in practical terms? It means that I don't try to predict exactly when the market will crash. Nobody can do that. Not me, not Warren, not anyone. But I can tell you this with absolute certainty. If you are a retiree today, and you have more than about 60% of your portfolio in stocks, you are taking a risk that you probably don't understand. Now, I know what you're thinking. Charlie, the market has been going up for years. Why would I want to miss out on those gains? And that's exactly the question that people were asking in 1928. That's the question they were asking in 1999 before the dot-com crash. That's the question they were asking in 2007 before the financial crisis. And every single time, the people who asked that question ended up regretting it. Let me explain something about human psychology, because this is really at the heart of everything I'm trying to tell you. Human beings are not rational creatures. We like to think we are. We like to believe that we make decisions based on logic and evidence. But the truth is, we're driven by emotions, fear and greed, mostly. And these emotions make us do incredibly stupid things with our money. I've spent decades studying what I call the psychology of human misjudgment. And I can tell you that there are certain predictable patterns in how people make mistakes. One of the biggest is what I call social proof. We look around at what everyone else is doing, and we assume that must be the right thing to do. If everyone is buying stocks, then buying stocks must be smart. If everyone is taking on debt, then taking on debt must be okay. But here's the problem. Everyone can be wrong. And when everyone is wrong at the same time, that's when you get a crash. I remember a conversation I had with Warren many years ago. We were talking about the insurance business, which is something we both know a lot about. And Warren said something that stuck with me. He said, "Charlie, the most dangerous thing in investing is a long track record of success." And at first, I didn't understand what he meant. Isn't success a good thing? But then I realized what he was getting at. When you've been successful for a long time, you start to think you can't fail. You start to take bigger risks. You start to believe your own press, and that's when disaster strikes. Now, let me talk about what I think might happen in the next few years. And I want to be clear about something. I'm not making predictions. I don't do predictions. But I can tell you what I see, and I can tell you what history suggests. When I look at the world today, I see some things that worry me. I see debt levels that are higher than they've ever been, both in governments and in households. I see asset prices that seem disconnected from underlying value. I see a generation of investors who have never experienced a real bear market, who think that buying the dip always works because it has always worked for them. And I see central banks that have painted themselves into a corner with interest rates that were near zero for so long that there's no room left to cut. If we get into a situation in the next couple of years, say 2025 or 2026, where something unexpected happens, whether it's a war or a pandemic or a financial crisis or something we can't even imagine right now, I think a lot of people are going to be caught completely off guard. And the people who will be hurt the most are retirees, because when you're retired, you don't have time to wait for the market to recover. You need that money now. You need it to pay your bills, to buy your groceries, to keep a roof over your head. You know what the greatest investment skill is. It's not picking stocks. It's not timing the market. It's not any of that complicated stuff that people write books about. The greatest investment skill is the ability to sit on your hands and do nothing. I know that sounds strange. We live in a world that worships action. We're told that successful people are always busy, always moving, always doing something. But in investing, the opposite is true. The best investors I've ever known are the ones who can resist the urge to do something. Let me tell you about my friend Warren. You probably know who he is. We've been partners for over 40 years now, and I've watched him make decisions that most people would consider crazy. I've watched him sit on billions of dollars in cash when everyone else was deploying capital. I've watched him pass on deals that looked attractive because something just didn't feel right. And I've watched him wait, sometimes for years, for exactly the right opportunity. That kind of patience is rare. It's unnatural, but it's essential. Now, here's what I want to say to the retirees who are watching this. You are in a different situation than a young person. A young person can afford to take risks because they have time to recover from mistakes. If you're 30 years old and the market crashes 50% tomorrow, you've got another 30 or 40 years to make that money back. But if you're 65 or 70 or 75, you don't have that luxury. Time is the one thing you can't buy more of. So what should you do? Well, let me tell you what I would do if I were in your shoes. First, I would take a hard look at how much risk I'm actually taking. And I don't mean what your financial advisor tells you. I mean what you actually understand about your own portfolio. Do you know what would happen if the market dropped 40% tomorrow? Not in theory, but in real dollars. How much would you lose? And more importantly, could you live with that loss? I remember talking to a man once, a very successful businessman, who told me he was comfortable with volatility. He said he could handle a downturn. And I asked him, what about a 40% drop? He said, oh, sure, no problem. And then I did a quick calculation. I said, you know that 40% of your portfolio is about $2 million, right? He went pale, because when you put it in real numbers, suddenly it doesn't feel so theoretical anymore. The second thing I would do is make sure I have enough safe money to cover my expenses for at least 5 years. And when I say safe money, I mean really safe. Not corporate bonds that might default. Not dividend stocks that might cut their payments. I mean treasury bills, money market funds, maybe some short-term government bonds. Boring stuff. Stuff that won't make you rich but won't make you poor either. Why 5 years? Because that's roughly how long the average bear market takes to recover. If you have 5 years of expenses and safe money, you can afford to let your stocks ride out a downturn without having to sell at the worst possible time. And trust me, selling at the worst possible time is what destroys most investors. It's not the crash itself. It's the panic selling that follows. You know, one of the things I've learned in my life is that the simple things work best. People always want complicated solutions. They want sophisticated strategies and exotic investments and clever tricks. But the truth is, most of that stuff is nonsense. It's designed to make money for the people selling it, not for the people buying it. The simple approach to retirement investing is this. Figure out how much money you need to live on. Make sure that money is safe. And then, with whatever is left over, invest in good businesses at reasonable prices. That's it. That's the whole strategy. It's not exciting. It won't make you rich overnight, but it will keep you from being poor. And at my age, I can tell you that's a lot more important than getting rich. Let me tell you something about the 1929 crash that most people don't know. The stock market actually started declining in September of 1929. By early October, it had already dropped significantly. But here's the thing. Most people didn't panic at first. They had been told by experts, by the newspapers, by everyone around them that the market was fundamentally sound. They had been told that any decline was just a buying opportunity, so they held on. Some of them even bought more. And then came Black Thursday, October 24th. The market dropped 11% in a single day. But even then, some people thought it was over. The worst had passed, they said. The market would recover. And for a few days, it seemed like they might be right. The market stabilized. Some stocks even went up a little. But then came Black Tuesday, October 29th. And this time, there was no recovery. The market just kept falling and falling and falling. By the time it finally bottomed out in 1932, it had lost almost 90% of its value. 90%. Can you imagine if you had $100,000 invested in the stock market in 1929, by 1932 you had $10,000. And here's the really tragic part. It took 25 years for the market to recover to its 1,929 highs. 25 years. If you were 60 years old in 1929 and you had all your money in stocks, you would be 85 before you got back to where you started. And of course, most people couldn't wait that long. They had to sell. They had to live on something, and so they locked in their losses and spent the rest of their lives in poverty. Now, I'm not saying that's going to happen today. I don't know what's going to happen. Nobody does. But I am saying that it's possible. And if it's possible, then you need to be prepared for it, because hope is not a strategy. Wishing that the market will go up is not a plan. The only thing you can control is your own behavior, your own decisions, your own preparation. I want to talk for a moment about something that I think is particularly dangerous for retirees today, and that's the cult of the financial advisor. Now, don't get me wrong. There are some good financial advisors out there, people who genuinely care about their clients and give good advice. But there are also a lot of people who call themselves financial advisors who are really just salesmen in disguise. You know how you can tell the difference. Look at how they're paid. If they're paid based on commissions, they have an incentive to sell you things that might not be in your best interest, things that might have high fees or hidden risks. On the other hand, if they're paid a flat fee or a percentage of assets under management, their interests are more aligned with yours. They make more money when you make more money. But even the good advisors have limitations. They can't predict the future any better than you can. They can't protect you from market crashes, and they can't make decisions for you. At the end of the day, you are responsible for your own financial well-being. You need to understand what you own and why you own it. You need to be able to sleep at night, regardless of what the market does. And if you can't do that, then you need to make changes until you can. I remember when I was younger, I used to think that intelligence was the most important thing in investing. I thought that if I just studied hard enough, read enough books, analyzed enough data, I could figure out the market. But as I got older, I realized that intelligence is actually overrated. Some of the smartest people I know have made terrible investment decisions, because intelligence without wisdom is like a car without brakes. You might go fast, but you're eventually going to crash. What matters more than intelligence is temperament. The ability to remain calm when everyone around you is panicking. The ability to think long-term when everyone else is focused on the next quarter. The ability to admit when you're wrong and change course. These are the qualities that separate successful investors from unsuccessful ones. And they're qualities that can be developed with practice. You know what I do when the market starts to get crazy? I read history. I read about previous crashes and how they played out. I read about the people who survived and the people who didn't. And what I find over and over again is that the people who survived were not necessarily the smartest or the richest. They were the ones who were prepared. They were the ones who had made conservative decisions before the crash, not after. Let me tell you about Benjamin Graham, who was Warren's mentor and one of the greatest investors who ever lived. Graham had a concept that he called margin of safety. The idea is simple. When you invest in something, you should build in a cushion. You should assume that things will go worse than you expect. You should prepare for the worst while hoping for the best. This is not pessimism, it's realism. It's acknowledging that the future is uncertain and planning accordingly. For a retiree, margin of safety means having more safe money than you think you need. It means being more conservative than you think you need to be. It means saying no to risky investments, even when everyone else is making money on them. Because when you're retired, you can't afford to be wrong. You don't have time to recover from mistakes. I want to share something with you that I think is profound. The Roman philosopher Cicero wrote a treatise called On Old Age more than 2,000 years ago. And in it, he talked about how to live well in the later years of life. He said that the key to a good old age is to have built a strong foundation in your younger years. The same is true for money. If you want financial security in retirement, you need to build it before you retire. You need to save more than you think you need. You need to invest more conservatively than you think you need. You need to prepare for the worst while hoping for the best. Now, I've been talking a lot about what not to do. Let me spend some time talking about what you should do, because it's not enough to avoid mistakes. You also need to make good decisions. The first thing I would tell any retiree is to know yourself. Know your own risk tolerance. And I don't mean what you think your risk tolerance is when the market is going up. I mean what your risk tolerance is when the market is crashing, when you're watching your portfolio drop 10% in a week, when all the headlines are screaming about financial collapse. That's when you find out what your real risk tolerance is. And if you've never experienced that, you might want to be more conservative than you think. The second thing I would say is to diversify, but diversify intelligently. A lot of people think diversification means owning 100 different stocks. But that's not diversification. That's over-diversification. True diversification means owning assets that behave differently from each other. Stocks and bonds, for example, or U.S. assets and international assets, or stocks and real estate. The point is not to own more things. The point is to own things that won't all go down at the same time. The third thing I would say is to keep your costs low. This is something that most people don't pay enough attention to. Every dollar you pay in fees is a dollar that's not working for you. And over time, those dollars add up. I've seen studies showing that the average investor loses about 2% per year to fees and expenses. 2% doesn't sound like a lot, but over 20 or 30 years, it can cut your wealth in half. You know who understands this, Warren and I. When we make investments, we're always thinking about costs. We're always looking for ways to minimize expenses. Because we know that in the long run, costs are one of the biggest determinants of investment success. The fourth thing I would say, and this might be the most important, is to think for yourself. Don't let other people make your decisions for you. Don't follow the crowd. Don't believe everything you read in the newspapers or see on television. Most of what passes for financial news is just noise. It's entertainment, not information. And if you base your investment decisions on it, you will almost certainly make mistakes. I remember during the dot-com bubble, everyone was telling me I was crazy not to invest in internet stocks. They said I was old-fashioned. They said I didn't understand the new economy. And you know what? Maybe I didn't understand the new economy. But I understood one thing. I understood that when someone tells you that this time is different, it usually isn't. The internet changed a lot of things, but it didn't change human nature. It didn't change the fundamental laws of economics. It didn't change the fact that most businesses fail and most stocks underperform. So I sat out the dot-com bubble. I missed the gains on the way up, but I also missed the crash on the way down. And when all was said and done, I was ahead of the people who thought they were smarter than me. Not because I'm a genius, but because I was patient and I was skeptical and I didn't let the crowd push me into making stupid decisions. Let me tell you what I think is going to happen in the next few years. And again, this is not a prediction. I don't make predictions, but I can tell you what I see, and you can draw your own conclusions. I see a lot of excesses in the financial system. I see companies that have never made a profit trading at valuations that don't make any sense. I see people buying things not because they have any intrinsic value, but because they think someone else will pay more for them tomorrow. That's not investing. That's speculation. And speculation always ends badly. I also see a lot of complacency. People have forgotten what a real bear market feels like. They've forgotten what it's like to watch your portfolio drop 50% and not know if it will ever recover. They've been conditioned by more than a decade of rising markets to think that stocks always go up, that the Federal Reserve will always bail them out, that there's nothing to worry about. But that's not how the world works. Sometimes things go wrong. Sometimes they go really wrong. And when they do, the people who weren't prepared suffer the most. If we see a serious market correction in 2025 or 2026, and I think there's a reasonable chance we will, a lot of retirees are going to find themselves in trouble. They're going to have to sell stocks at depressed prices to pay their bills. They're going to have to cut back on their lifestyle. They're going to have to go back to work if they can find work. And some of them are going to run out of money entirely. This doesn't have to happen. It's not inevitable, but it requires making some hard decisions now before the crisis hits. It requires being willing to accept lower returns in exchange for lower risk. It requires having the discipline to stick with a conservative strategy even when everyone else is getting rich by taking crazy risks. You know, I've lived a long life. I've seen a lot of things. And if there's one thing I've learned, it's that the world is always more uncertain than we think it is. We like to believe that we can predict the future, that we can control our destiny, that bad things won't happen to us. But the truth is, the future is unknowable. The best we can do is prepare for multiple scenarios and hope for the best. I think about my grandfather sometimes. He came to Omaha in the early 1900s with almost nothing. He built a successful business through hard work and thrift. And he taught me something that I've never forgotten. He said, "Charlie, it's not about how much money you make. It's about how much money you keep." And he was right. The people who do well in life are not necessarily the ones who make the most money. They're the ones who manage their money wisely, who live below their means, who prepare for the future, instead of assuming everything will work out. So here's my message to you. If you're a retiree watching this, be careful, be prudent, be skeptical of anyone who tells you that you can have high returns without high risk. Take a hard look at your portfolio and ask yourself if you're really prepared for a serious downturn. And if you're not, make changes now while you still can. I know this isn't the kind of advice that sells. It's not exciting. It's not glamorous. It won't make you the hero of your next cocktail party. but it's the truth. And at my age, I've got nothing to sell you. I've made my money. I don't need any more. All I want is to share what I've learned in the hope that it might help someone avoid the mistakes that I've seen so many people make. You know, Warren often says that the first rule of investing is don't lose money, and the second rule is don't forget the first rule. He's being a little flippant when he says that, but there's real wisdom in it, because the math of losses is brutal. If you lose 50%, you need to gain the 100% just to get back to where you started. And the older you are, the less time you have to make up those losses. So be careful out there. The world is a dangerous place, and the financial markets are no exception. But if you're smart, if you're patient, if you're willing to think for yourself and make hard decisions, you can protect yourself. You can preserve what you've worked so hard to build, and you can sleep at night knowing that whatever happens, you'll be okay. That's what I've tried to do with my own money, and that's what I would encourage you to do with yours. Not because I'm smarter than you, but because I've been around long enough to know that the people who survive are the ones who prepare, the ones who don't take unnecessary risks, the ones who remember the lessons of 1929, even when everyone else has forgotten. Thank you for listening to an old man ramble. I hope something I've said has been helpful, and I hope you'll take it seriously, because the decisions you make today will determine how you live tomorrow. Make them wisely.